Alright guys, good morning. It's Saturday. This is usually when I do my homework for the next week, and so I thought I'd take this little chance to kind of give you some basics that some of y'all might be struggling with or not quite aware of what they are or how they work. So we're going to kind of go through some of this stuff real quick, and some of it I'll kind of get a little bit deeper into, but some of the other stuff I'll save for another day. Like I said the other day, I'm planning on getting tutorials up online for you. These are just for y'all to use. I mean, I don't expect anything in return from them. I'm just kind of trying to share some of the knowledge that I have gained over the past decade plus. So take it for what it's worth, okay? All right. So you're looking at the S&P 500, of course. That's where I always start at. And the reason I wanted to kind of start here is because one, it's the where I always start, but two, it's kind of a good way to kind of get an idea of some of these simple concepts here that we're looking at. The first thing I want to talk about is just the chart itself. So I've kind of fixed up some of these time frames to make it a little bit easier for me to switch through this stuff for you, so I don't take up quite as much time. We were looking at a daily chart here to begin with. It's 1 year in time. So when I talk about a daily chart, 1 year, you're looking at 1 year's worth of data here, and each bar on this chart represents 1 day of trading. This is the OHLC chart, which is one of my favorites for technical stuff. And if you kind of look in here a little bit closer, I'll kind of show you why they called it an OHLC. And we'll get this made up a little bigger here. Okay, the OHLC stands for open, high, low, and close. They have two different colors pretty much, red or green. And I'm pretty sure you can guess which means what. But if you look at, say, like this candle this bar right here. This is let me go ahead and get my drawing tools going here. Okay. We're going to look at this candle right here. And we are going to notice that over here on the left-hand side, there's a little tick mark points to the left. That is our opening price. We have our low, which happens to be about the same point there that day. We have our high, which is at the top of the bar here, and then our close, which is the tick on the right hand side. Now in this case, looks like the opening price was the low of the day. So on one of these other candles, say like this one right here, we see that we opened, we have a high at the same point up here at the top, or a little bit higher than the open. We had a low down here at the bottom, and we had a closing price right here. So these are kind of a good idea to kind of look at that and get an idea. If it is a green bar here, that means we closed higher than the previous close, and if we have a red bar, we close lower than. Now there's a time that you can have a red bar and a green candle, or vice versa, and that is because of the previous day's close and or the opening price. So we'll get a little bit deeper into that kind of stuff a little bit later on. But basically, this is kind of one of the main types of chart that I like to use here. So I kind of wanted to talk about it just right off the bat. One of the other ones I use, and I mentioned it yesterday, is called a candlestick chart. This is a candlestick chart here, the same time frame, 1 year of the S&P 500. If you kind of notice here, they kind of give you some of the same information, and we'll kind of zoom in here to see what I'm talking about. But if we look right here, we find us a good candle. Okay. How about that guy right there? I see him right now. Let me get my drawing tools back up here, and we'll kind of point him out. Okay, so there's a candle right here, this red one that we'll talk about, that shows a little bit of stuff, and then we'll go over here to this green one right next door, and we'll talk about it a little bit as well. So on this red one here, we had an opening price. If it's a red candle, it means it closed lower than it opened. So we have a opening price at the top of this body. They consider a candle here, and I'll kind of do a freehand, and this is going to be really rough looking, but we'll kind of see how it works. We have our candlestick. We have our opening price, and then this is becoming the body here is what we call this. So in this case, if this were a red candle, your opening price would be right up here at the top, your closing price would be down here at the bottom, and then this is your low and your high, of course, up here at the top. If this were a green candle, it would be the exact opposite. These two would be. So that's kind of an idea, and like I said there a second ago, we're going to talk about the green candle next door to it. So in this case, we closed higher than we opened. So it looks like we opened up, and at some point during the day we drove off down here to this low that was set at the bottom of the candlestick. We have somewhere touched this tip top up here, but we ultimately closed just fractionally higher than we opened that day. That's kind of what they say is it's a battle of the bulls and the bears in those kind of cases. So like this candle up here, you see this long stick going all the way down through here. This is kind of a bullish signal, actually. You might not think so, But what happened here was it looks like we opened up at this level right here. Intraday, we came up here and touched some of these higher levels, and then some point in the day, we drove all the way down here to the bottom. But before we closed that day, the buyers were able to come in and buy shares back up so that we closed back up here at this level. That is kind of a bullish indicator from a candlestick chart analysis kind of point of view. So that's kind of one of those things that you got to kind of keep an eye on when you see these. And they start getting really deep, and I'll put some links online for you. They have the dojis, the bullish engulfing, so there's a lot of different patterns that you can kind of be on the lookout for to help you kind of determine the next move. So that's just kind of a basic on the candlesticks, and we'll look at the mountain. This is one that people that are beginners may want to kind of start with just for a big picture kind of glimpse, and also for a ballparking it kind of thing. Now, I don't necessarily advocate ballparking it, but sometimes it does work. And if you look here on this S&P, we kind of have an idea of why. The markets kind of do have a tendency to follow these round numbers. So we're going to look here at this. This is 1,500 that I'm marking, and we came down to 1,000 roughly before we kind of bounced around and went higher. So you notice we kind of come on up here from the 15 to 2,000 is right here. Now we're just looking at 500 point increments before we kind of had to kind of correct a little bit, and now we have blown by 2,500. Without much kind of correction. So that's kind of why I feel like that we have kind of overdone it to the upside in this perspective. So, usually you want to kind of stick with your more specific and not quite so generalized numbers, but you can kind of roughly say that, hey, look, we're doing 500 point moves before a major correction. So if that's the case, we should go from 2,000 to 25 and back down to 2,000 before moving back up to 3,000. I'm not saying that's what's going to happen anytime in the near future. I'm just kind of, like I say, this is this is a chart going back 30 years. So that's kind of a look at the mountain chart. There's another one called a point and figure here, and I was wanting to pull it up, but I thought it'd be kind of cool to walk you through how I pull these things up. So on mine, it doesn't look quite that well, and it's trying to load there. Okay, so I'm not going to get into the details of the X's and the O's, but I'm going to show you over here. Let me find my... Okay, here we go. Alright, so we're just starting here with Google, and this is kind of my home page, of course. So I'm going to give you stockcharts.com. We'll kind of pull this up, and this is how it looks when you get there. This is one of my favorite sites. I keep this running off in the side for kind of big picture things. I don't do subscriptions to it, but you can. And if you need a charting software program or a charting thing, they have a lot to offer here, and I will show you just real quick, kind of roughly. They do charge a per month fee, and you can get a little bit of a deal usually if you buy it in like a year in advance. There's a lot of options out there. This is just one of the ones I like. But like I say, I do not have a subscription, and I'm not necessarily advocating you go get one unless you absolutely need some charting software. So we'll pull up the S&P 500 here too. And I'll go ahead and do a few things because I have some pretty large monitors here. So I'll go ahead and make this a landscape, and I give it a full quote, and I put the price labels. And you can go ahead and update that to reflect that. What we did is we gave all this information up here. That was the full quote situation. Putting the price labels, we got these little highs and lows, peaks defined for us, and obviously it made the chart a little bit bigger. One other thing I like to do is I like to go down here to the overlays, the default, and this is why I said the other day that this is one of those things that the whole market tends to look at, is the 50 and the 200-day moving average, and the defaults here are 50 and 200. So again, this is kind of one of those things that, let me make this black so it's a little bit easier. So the 50 is here, the 200 is here, and it gives you room to do one more. You could put a shorter term, like say a 20-day in there if you wanted to, but one thing that I just kind of like to do here, and I'll show you, is if you just click on that, the very top option is called your Bollinger Bands, and if you just update that, that gives you both the bands and a 20-day moving average. This little dotted line is the moving average. Pop-ups are taking over the world, my goodness. Anyway, so this little dotted line is our 20-day moving average. The solid lines are the top and the bottom limits of the Bollinger Bands. Those are trading indicators in and of themselves. So you could look at, say, people do what they call the trading the bands, and so you would be selling against this upper band, expecting it to touch the bottom band at some point. Of course, like you can see here, if you do that by itself, you might be selling back here, selling again here, 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 so forth and so on, and you're just now starting to get a point to where you can kind of, you're still going to be exiting in a loss, but you're not quite as far in the hole. So it's not a trading indicator by itself, that I can use. You might be able to look a little bit shorter time frame and get a little bit better things out of it, but for a daily thing, or from a daily perspective anyway, I just don't necessarily think that it's the best indicator. Over here you see that we touched the bottom, and then we did bounce higher. So if you bought the bottoms of the bands, you might be doing okay. But if you if you shorted the tops, then you're probably kind of in an underwater situation right now. Okay, so I just wanted to kind of show you that this was available for you. They don't offer a whole lot for the free version. You can look at a weekly chart if you wanted to, and that is here. So this is and it defaults to candlesticks on this one as well. So if you kind of notice, it comes with the RSI built into it. We still have our moving averages. Now I have to consider that these are weeks in this point because each bar is now representing a week. And then of course down here at the bottom, and one other thing, and I kind of have mine separated from my chart, but if you kind of notice here, they do have the volume over or behind the bars there, so you can kind of change that around. You can tell it to put it at the bottom or at the top. I mean, however you want to look at it is fine. That's entirely a preference thing. This down here is our moving average, so that's kind of one of those that we like to look at. But I will say that here, especially on stock charts, one of the ones you can kind of use, especially if you're a little bit longer term, is if you go down here to the bottom where you're looking now at indicators instead of overlays. And I'm going to go down here and see if I can find it. Where did it go? There it is. The tricks is pretty much a moving average of moving averages. So it is a little bit smoother. If you notice, it's kind of similar in the sense that they kind of look the same. We're kind of going this above or below zero. You have a shorter term with the black and a longer term indicator with the red. So whenever you get a shorter term over the longer, that's a buy signal. But in this case, it tends to provide a little bit less of a false sense of breaking out or something. So you notice over here, say, let's look at, well, so like in this case right here, we had a sell signal because that black line dipped down below the red one there, because that black is the faster of the two. And then we got it in this one as well, but it's not quite as wobbly. So where like in this one started to almost roll back over, this one was still showing that you could stay with it. So it's just kind of smoothed out, and it's a little bit, it's definitely less sensitive, so you have to be a little bit careful there because you will be lagging behind the market if you are just relying solely on this. But it is a good indicator to stick on there instead of, or in supplement to the moving average conversion here. Okay, let me get away from this, and we're going to get back over, oh no, let me pull that back up for you. One of the things I was going to say here, and so let me switch back over to our daily chart just real fast. You can take a look now. I was talking about the point and figures over on my chart here, which was looking kind of wonky because of the way that Fidelity has their stuff set up. But if you scroll right down here to the bottom, if you just click point and figure, it'll bring it up for you. Now, one nice thing about the P&F charts is that they don't really matter. The time frame does not matter. So some of these you'll see like 2005, 6, 7, all right beside each other because the price did not move during that time. This one though, we did get this is actually pretty interesting. I just noticed this the other day. We got a high pole warning, which is one of the indicators used with the P&F, or one of the recognitions people see in there. So it did give us a warning that we are looking to reverse here in the S&P 500. So if you notice, then I will say this real quick. There's X's and O's, and these are not hugs and kisses. These are X's represent climbing prices, O's represent declining prices, and these are in 10, let's see, they got these in 10 intervals. So it takes a 10-point move for it to make a new box fill in. And the 1, 2, 3, 4, 5, 6, those are the months, and so you think there's 12 of them. How do they get 10, 11, 12 in there? They use ABC, and that's these numbers right over here, or these letters right over here. That's why it's 1, 2, 3, and then over here you see an ABC. So this was December, November, and October, and then the rest are the numerical months. So that's just kind of one that you can kind of look at from a large perspective or a bigger perspective. And I think I was in Boeing when I noticed that one that. Yeah, so okay, take a look at Boeing here. So some of these years between 16 and 17, you can, or I'm sorry, 17 and 18, you can see it's not a lot of space compared to say like 15 and 16. That's because in the year 2015 and all the way up to 2016, the price just kind of stayed in this range here. And then finally it did break down a little bit. But we have now set up a blast off to the higher. And that's one of the reasons I actually have been looking to short and have already shorted via credit spreads shares of Boeing, and it worked out pretty well. So I'll think it's a great company. I think they're doing some really good things, and I think that air traffic traveling and all that kind of stuff will only go up. But that being said, there's only so much I'm willing to pay for a company based on how much they make. So I will be sipping coffee, here and there in between this time. And one other one here, real quick. So I just want to let you know, if you're hearing me sip there. There's another site called TradingView, and I do use this one a little bit, but not a lot. I'm gonna pull up my page here. You can go to them and just pull up and the nice thing here is you can see a intraday chart, or you can kind of get down a little bit closer into it without having to pay for it. You can see I've still got some stuff up there from the last time I was here. Oh, go away. There we go. Okay, so this one is pretty much similar to the one that I have on my other screen. You will notice that I do have a 5 and a 13 exponential moving average, but I've also added a 34 period moving average as a really slower average to work with. It works out well. I used to use an 8-34 combo, but decided to go to a 5-13 because I was getting more and more active. So the 8-34 EMA combination is a good one to use if you need a little bit. If you're a little bit less active than say I am. So that's kind of what some charting options you can have and you can turn to there. Like I say, this one goes to go intraday, so you can take a look at a 1 minute chart here if you wanted to, or a 3 minute, or you can look at a 50 minute or 30 minutes, or a whatever, weeklies, monthlies, and yada yada yada. So that's a couple sites you have there to use, and I think that those are some of the best ones out there. Like I say, Stock Charts is probably my favorite. But this TradingView is a pretty good one too. One nice thing I will say about TradingView is that, let me get over here to the live chart. Screw it. Okay, so like this one, you can look at, say, the Bitcoin and some of these cryptos. If you do want to track those, like I say, I'm not really heavily involved with those because they're a little bit foreign to me. I don't really understand them. I don't understand how you can go from 0 to 20,000 in a matter of a couple of years, and people are still buying it. That don't quite make sense to me. And if you look at here at this Bitcoin chart, let me go out to a longer time frame just to show you, because this is crazy. This is literally 2014 here. Right? The first month that it reported there was a open at 93.3, a high of 100, and it closed at 93.1. And these numbers are coming right up here, by the way. So back in March of 2013, so a mere 5 years ago, this thing was worth $100, and now a couple months ago it went all the way up to touch 20,000. So I actually bought it about, I think it was, it was about 2,500. So somewhere in this area is whenever I threw, I think, $100 at it. And after this little spike up, I ended up selling up here at about 17,000. I just did not, I could not justify keeping the money in there. So that's Bitcoin, and you can do the other ones there, the Litecoins and the Ethereums or whatever they're called there as well. So that's the nice thing to TradingView compared to Stock Charts. Okay, so the intraday, I mentioned, you see a lot of times I'll be showing the intradays, and I'll be looking at a 1 minute chart, meaning each bar here is 1 minute in time. So these are prone to a lot of moving and a lot of false readings and stuff. So like right here, you noticed we had the bullish crossover that we were talking about on some of the stuff there yesterday. So let me change this color because this is a black background. Okay, so here we had this moving average crossover. We took out this high and we started to pull back, but we ultimately, again, we had a bearish crossover. It looked like we were going to hold here actually for a brief second. We started to rally, but whenever the moving averages did not confirm that, we ended up leading lower, and we started setting a new low. We took out this one to a new one, and again we started trying to rally, but it just failed, and we took out that low to set a new one, before finally getting down here to the 200-day moving average, where we finally found a bid. I think it was at 239. So that was kind of where, let's see here, there's 225.40. So the 200-day moving average was sitting right in here, so that's why we ended up bouncing from that level intraday yesterday. Okay. The other thing I wanted to say here is that you can also, if a 1 minute is a little too crazy, and it is sometimes, especially with more volatile names, you can do a 3 minute. That's a very good one to use. Where did it go? A 3-minute chart is just what it sounds like there too. It is, each bar now is a 3-minute block of time, so it's a little bit unorthodox, but it's pretty common to use that. And so in this case, you see that if you'd have been using a 3-minute instead of a 1-minute chart, you would have seen this moving average cross over here. That's a bullish signal, but notice we failed to take out that high there. So that was a cue that this might be a false breakout, and sure enough, we pulled back and we got the flip back over here, and we fell on down to, like I say, that 200-day moving average. Once we got the next crossover to bullish, and then you see we took out this high, that was the cue that, hey, now we can buy it. So you got to see some kind of capitulation there in terms of prices. People were not willing to pay higher prices here than they were here, so that was why we ended up having the sellers take over, and they pushed us back down until the buyers were willing to step in there. And once the buyers or sellers, either way, once the market starts getting some momentum, people start piling into the trades, and they start kind of doing the same thing that we're doing. They're watching all these indicators, and so if they see this signal, and then they see us take out this high here, they do the same thing that we do. They buy, and so that kind of becomes a self-fulfilling prophecy. This one was one of those kind of false breakout indicator things here. We had the crossover, we took out the low, but we are rebounded. So whenever we kind of came back up, you got the next crossover. Notice we did not take out this high right here in this move here. So you kind of been head fake there, but it just didn't fall. So the fact that the moving averages stayed in a bullish buying mode, you could have stuck with it. You might have gotten stopped out, but if you were trading intraday based on this swing, you probably would have gotten screwed over there. This is also, we'll get into this another day, but this is called a two-step pattern here, it looks like, where you have a rally, a decline, a rally, two. So you got a one here, a two here, then we go higher. So that's kind of a pattern that you can kind of look for. So if you'd have been aware of that, you probably would have been okay. But if you'd just been strictly using the moving averages and the breakout levels there, then you would have been kind of probably left hanging, holding the bag. Okay, so these are the various types of charts, and these are some of the various kind of indicators that we look at when we're talking about these. I do want to also say real fast before we wrap this video up here that, whoops, no, see, I did this the other day just so I wouldn't have to do all this. So a 5-day 5-minute chart is a good one to use if you plan on holding something maybe 2 or 3 days. A 10-day 15-minute chart is good if you plan on holding it for, say, 3, 4, 5, 6, 7, 8 days, something like that, up to a couple weeks maybe. The hourly chart, talking about maybe a couple weeks or a month, and the 120 is good if you're looking at, say, maybe a couple weeks to a couple months. Daily, and it's one of these things. There was a woman I used to watch and learn quite a bit of stuff from her. Her name was Carolyn Borden. She's known as the Fibonacci Queen, and one of the things that she always would say is you got to stick with what you see here. You can't don't fight it. Don't fight the tape, and just kind of take what you're given and make your decisions the best you can based on that. So here we were looking to sell because we took out this. And we were correct, and then if we had been on top of things, we would have been looking for the next leg down, but like I said, in this case it didn't happen. But the fact that we set a higher low here, that was probably a cue that we probably should have exited our short trade. And the other thing that I was going to say in regards to Miss Fibonacci Queen there was always make sure you're trading the correct time frame. If you were planning on holding something for 30 minutes or 3 days, there is no point really in necessarily looking at a 10-year weekly chart. That's not to say that you can't get some bigger picture ideas here, because there's a time and place for everything kind of thing. So if you were bearish because of this right here, this stuff going on here, you might have just sold everything at this little peak and expected this just to fall apart, and you would have not been cued that you were wrong until a little bit later than had you been looking at a daily chart. So like I say, make sure you're using the correct time frame for what you're trying to achieve. I don't know why it does it sometimes, but anyway, so guys, this is just kind of a beginning tutorial guide. I'm gonna kind of go back through this and see if I can cut out or add to stuff. I might have got a little off topic talking about the breakout and stuff, but anyway, I just kind of wanted to give you all some heads up on some stuff that we will be talking about on a regular basis going forward to help you kind of understand the technical situations of markets and the technical pictures and some of the technical indicators that we use, and how you can use them to your advantage as well. Alright, this is going to be the conclusion here of this first video, and let me take a look at it, and like I say, if y'all have any questions, shoot me a message on my Facebook page, or private message me, or however the hell the people do this stuff these days. You know how to get in touch with me. I've had the same phone number for 15 years, 20 years, so be in touch, and I will do the best I can to help you ends out. All right, talk to you later.